First of all, it has been such a pleasure to be here. This is the first time I'm attending Carnival such as this. And the sheer amount of information, knowledge, and experience that is available here, hats off to putting it together. Thank you so much. Big round of applause for DJ and Rekha for putting this together. The way I look at the markets is that it is this big playground, and all of us who enter it, we try to create small boundaries for ourselves. We try to set a few rules for ourselves and try to play our own little game. And over a period of time, if we do it consistently with discipline, we'll manage to do all right. So that's how I look at the markets. And everyone here is playing their own little games and doing really well at it, and that's really nice to see. So before I get started, a little bit about myself. I come from a finance background. I don't particularly think my MBA in finance gives me some kind of a big edge in the market. In fact, none at all. And I think what has helped me is that I'm good at basic math, and I have practiced discipline with an intense ferocity, right? When I started out, I started my account when I started doing it seriously with about 10 lakhs and eventually added about 30 lakhs to my account. From there has been no capital infusion whatsoever, and as of today, after my obligations to the government and whatnot, my account stands at about 5 crores. So that has been my journey. Thank you. In that, 300% has been in just since last March. So there has been great opportunity, and 300% has been there. And 50% is my current financial year as of April. You will find every single trade that I've ever taken in my trade book, trade log, which is available on a completely free public forum. You can go through every single trade that I've ever taken. They're all available for free. And the other thing is, I used to initially be completely away from social media, no social media presence whatsoever. My very good friend Ravi, who's in the audience, he spoke to me last year and said, you know what, I really need you to start documenting your trades and putting it up so that we can sort of have content available online where people can actually go through your trades. So we started logging this and started making video logs. So since the Jan of this year, every single trade that I've taken is video logged from the point where I make an analysis, I enter the trade live, I go about managing it, and I either book a profit or a loss, and that's more or less how it works. And since all of my trades are purely intraday, my exposure is only from the morning till the evening. So the entire day is done. What happens, which market overnight doesn't really matter to me at all. So all of that can be found on this particular YouTube channel. So that's enough about me. I want to focus on what it is that I'm going to be covering today. Today I'm going to try and put across how to look at the market from the perspective of probabilities and outcomes, right? How a bookie, right? So everyone knows what a bookie is. Right? Anyone who doesn't know what a bookie or a bookmaker is, show of hands. So everyone knows what a bookie is. So how to look at the market from the perspective of a bookie? A bookie doesn't really care about the outcome. He doesn't care if A wins or B wins. He just wants that on every rupee of bets that he accepts, he has to get away with at least 2 paisa, 3 paisa, 5 paisa, depending on what kind of risk exposure he wants. So that is what I'm going to be covering. And for the first part, I want to play a game, right? So everybody knows this game. It is a coin toss. And what is the probability of heads and tails? 50%, right? Let's play a game wherein I have 1 lakh of rupees and you have 1 lakh of rupees. And we are going to perpetually play coin toss. And you get to call heads or tails. After a year of playing this game, what do you think the P&L between you and I will be? 50-50? That means neither would have gained, neither would have lost, right? So we can say the expected value is the probability of you winning, which is 50%, and what you get when you win, which is, let's say, 1 rupee, right? For a win, you're getting 1 rupee. For a loss, you're losing 1 rupee. So it's very simple to calculate what is your expected value, because the game is very simple. There are only 2 outcomes, and there is only 1 risk, there is only 1 reward. Very straightforward game. Now, if I were to throw into the picture that for each time that we play this game, you have to pay the exchange, you have to pay the regulator, you have to pay your broker, you have to pay the government, and in many different ways, right? Now, if we continue to play this game, right, after a year, where do you think our accounts will stand? Okay, so you're saying 20%, arbitrary number, both of us will be in the negative. Neither you nor I am winning. Simply because And people talk about edge in many ways. I will talk about edge in a purely mathematical way, right? Your edge is nothing but what is the probability of you winning, 50%, into how much you win when you win. In this case, it's 1 rupee. But it won't be 1 rupee if there's charges, so it's less than 1 rupee. From this, you remove what is the probability of you losing. Once again, 50%. And when you lose all of your 1 rupee. So you will always have a negative equation because you're always losing more than what you win. So you can never make money. It is impossible, statistically impossible. You might have win streaks. You might win for a month in a row. You might beat me every single flip for a month in a row, but the next month that will nullify. And all these anomalies will get neutralized, right? That is how big numbers work. Over a long enough period, you cannot beat the math, right? I want to move on to the next game. And who doesn't know this game? Can I see a show of hands who knows which game this is? Show of hands for who knows which game this is. Okay, that's quite a few. But for those who don't know, this is the game of roulette. This is one of the casino favorite games. And it basically works like this. There is a wheel and there are 37 numbers on it. This is the European version, 37 numbers. You can bet in many ways. You can bet on a single number. You can bet on all the reds, all the blacks, first 18, second 18. You can bet on rows, columns. You want to bet on 2 numbers because one is your mom's birthday, one is your wife's birthday. You want to bet on both of them. You can do that. But accordingly, your winning also varies. So if you take a bet which is just one number, you get paid 36 times your money. You bet 1 rupee, you get 36. If you bet on all reds, which is there are 18 reds on the table, you will get 2 rupees for every 1 rupee you bet. So 1 rupee profit, basically, right? Now, there are many videos online on how to beat this game, how to win the casino at this game. And casinos love it. They love it because they know they have a statistical edge at this game. Right? And we'll take a look at how that edge comes. But they encourage you, yes, figure out systems, figure out martingales, how are you going to beat this game? And you go there. But finally, we all know what the outcome is. You're not going to win. So to figure out the edge in this, I am actually going to make this fun. I want to be the casino. And I want to accept bets. So anyone wants to place a bet? Can I have a couple of hands? Yes, sir. Yes, please tell me. You can bet on anything. You can bet on 1 to 18. You can bet on colors, odd, even, single number, your lucky number. On all even numbers, right? So between 0 to 37, there are 18 even numbers. And the odds I'm giving you are 1:2. So you bet 1 rupee, I'll give you 2 rupees back. Now what is the probability that you win? The probability that you win exactly would be 18, which is the number of chances you win, divided by total number of numbers, 37. 18 by 37. Now we came up with expected value in the coin toss. How do you know your expected value? Multiply the probability of you winning, which is 18 by 37, into how much you win when you win, which is 2. I'm going to give you back 2. So you get 36 by 37, right? That gives you a 97.3 expected value on a 100 rupee bet, which means every time you bet on that number, you are expected to lose 2 rupees 70 paisa per bet, regardless of what you do. You might win 10 times in a row, but once you start playing for long enough, every bet is going to lose you that 2.7 rupees. Now, people say, no, maybe I'll bet in a different way. I want another bet. I would do a different bet. Not on even numbers. Anyone else wants to place a bet? Single number, odd or even, black or red? No, it's okay. It's okay. It's fun. It's fun. Let's pretend this is Monopoly money. Anybody else who wants to place a bet? There are 18 blacks, 18 reds, and 1 green, which is the 0. The edge comes from the 0. The casino's edge comes from that 0 existing. Right? So basically, let me place a bet. Nobody else is placing a bet. Doesn't matter how you bet. Let's say you bet on a single number. I bet on my wife's birthday. Yes, please. You bet 1 rupee on red. The outcome will be the same because he had bet on even. You're martingaling. You're martingaling your bet. So I'll get to martingale, but let's take another simple example, right? Let's say you bet on a single number. The probability of you winning is 1 in 37. One number you bet on, 37 total numbers. You multiply that by how much I'm going to pay you, which is going to be 36. You will always get the magic number 36 by 37. Doesn't matter how you bet. You bet rows, columns, bet 2 numbers, 4 numbers, 6 numbers, whatever you do, 36 by 37. That's the magic number of the house. They will always retain that 2.7% edge over you. And you will always have a negative expected value because of that 0. So the next thing I want to move on to is how to ascertain probabilities of events based on what the price says. What is the best way to know who's going to win an election? Look at the bookies market. The best way to know who's going to win an election is not by looking at the exit polls. It is to know how much somebody is willing to put money on something. As long as somebody is able to risk their money on something, you know that is the most likely probability. So for the example here, I've actually pulled out the odds for tomorrow's match that we have with New Zealand, India versus New Zealand. And I want you to understand what is the bookie's edge here. Right now the odds are that if you were to bet on India, for every 1 rupee that you bet, you will get back 1 rupee 47 paisa. And if you were to bet on New Zealand, for every 1 rupee that you bet, you will get back 2.8 rupees. Right? And the probabilities roughly come to about 65% in the favor of India and 35% in the favor of New Zealand. How do we know what is the bookmaker's edge? Because if you ever want to be a bookmaker who wins regardless of the outcomes, you need to know what is the edge here. How would somebody calculate it? Anyone who wants to take a guess? How would you calculate this? Very simple. We go back to the same thing that we did in the first step, the second step, and now in the third game. You look at the expected value. 65% probability of India winning. So 0.65 probability into what is the odds? 1.47. Expected value is 0.95, which means for every rupee that you bet, you are getting a negative expected value of 5 paisa. You're losing. That is the bookie's edge. You put a bet on New Zealand. The probability of New Zealand winning, 0.35. You multiply that into what you get as the odds. That is 2.8. You get 0.98. Once again, 2 rupees, bookie's edge. That is his edge. It's mathematical. If a bookie is good and he's able to balance his book, which is balance his risk exposure, regardless of the outcome, he will make money. Right? So that is what we will be focusing on today. And with that, I want to now move on and apply the same thing that we learned. People say, this is my edge, that is my edge. And they might mean that they derive their edge from different things, but the edge itself has to be mathematical. Over a long enough period, it needs to be something that shows that between your probability of winning, how much you win when you win, your probability of losing, how much you lose when you lose, you need to use this structure and retain that over a period of time. That will be your edge. Now, we have the benefit of hindsight here. This is the option chain as I screenshotted it on Friday, right? On the Friday that was before the October monthly expiry. And this is how the option chain stood. I don't want to get into Greeks here, but I've also added the delta column. And delta roughly is the probability that a strike is at the money during expiry. It doesn't mean that it makes money. It means that what is the probability? It can roughly equate to that it will be at the money during expiry. Now, we know exactly how the expiry played out. So I want to now take a couple of trades from you guys. I want different people to place the trades. Now, we know exactly how the expiry played out. So you should know what kind of trades to place on the previous Friday with the benefit of hindsight. So can I have someone picking a trade, any trade, vertical spread, just long call, short put, whatever you want to do. Can I have some takers to place a trade, please? Yes. Okay. Okay, so you want to create a bear call spread, right? So if you were to sell the 18200 call, and I need to be able to see the values, my laptop is not working there. So you're selling the 18200 call for the price of 168, and you are buying the 18400 call. Sorry. Yeah, 112, and you are buying the 18400 for 46, right? So roughly, let's say 70 rupees, right? 70 rupees. So whatever system you have going for you has told you this 70 rupees bearish position you need to take. What is the max loss that you can take in this particular trade? The spread itself, right? So 200 rupees is the maximum loss that you can take. So right now, since 70 rupees is your maximum profit, assuming that you have no idea exactly how this system of yours is going to play out from a probability perspective, when you do lose, let's say you lose this 50% of the time, for the sake of simplicity, you obviously need to lose not more than 70 rupees. As long as you are able to do that, over a consistent period of time, you will keep a positive edge. Let me give you another example. Let us say you are buying the put option at the money, 18,150 for 144, and you have a stop loss of 120, which means the potential loss that you can take is 25 rupees. And your system, your logic, your analysis has given you this trade. And you always take a very similar kind of trade with a similar kind of reward to risk. You are going to assume that 50% of the time you are going to have your stop loss hit, and 50% of the time your target will hit. All you need to do is consistently over a period of time ensure that you maintain a higher reward to risk. This is the only thing that will make money for you. It doesn't matter what your analysis is, it doesn't matter how you arrive there, but this is the only thing. And to explain this in detail, I want to go over something Shubhashish said yesterday with his setup. He gave us a 5 EMA setup. Now I want to ask you a very simple question. We will give Shubhashish 10 lakhs and tell him he has to trade exactly opposite of his setup. When he gets a buy signal, he has to sell. When he gets a sell signal, he has to buy. Right? Similarly to the Piyush setup, right? We tell Piyush boss, you take the exact opposite trade. You're not allowed to take whatever your system is generating. And we gave the same 10 lakhs to another novice trader who's relatively new to the market. And we give them the original setup. They can follow Piyush's setup, they can follow Shubhashish's setup. I want to ask you a simple question, and I need a vote from every single person here. After a year of following these two setups, both candidates, the pro trader starting with 10 lakhs, and the novice starting with 10 lakhs, who do you think would have made money? Show of hands for people who think the novices who followed the setup would have made money, or at least tried to follow the setup. Show of hands for people who think that no, Piyush and Shubhashish would have still made money despite going against it. Why do you think that's the case? Risk to reward, exactly. See, everybody yesterday got completely carried away with, I'm sure, I mean, people here are far higher level than the average trader, and that's why I would think I'm probably a lot, this thing, I don't want to generalize everything, but a lot of people will get carried away by, okay, this is the setup, right? So this is the analysis. So when it crosses here, this is where I need to buy. But very little attention will be given to the fact that he said risk reward of 1:2, 1:3. 1:5 sometimes. Are you able to hold on to that trade till that long? Did you book out too early? Did you take the stop loss too late? Those behavioral aspects is what gives an edge, not the strategy. It doesn't matter which strategy you take. I mean, the biggest example is the live expiry trade that we did. We had 5 traders on stage, each one trading something completely different, and in fact, sometimes on the exact opposite side. You are having traders who are exactly on the opposite side, but simply because they have their discipline, their money management, and risk management in place. And even if somebody made a loss, it doesn't make them a bad trader. It's just because they have traded that particular setup so well over a period of time, they're able to maintain that positive edge over time by either controlling. A lot of the time, if you're a discretionary trader, you can't really control the probability of which trades you're going to win, which trades you're going to. You can assume that your analysis might be great, not great, 50%. But you can control this risk to reward, and that is where the edge comes from. So, using the options available to you, the different derivative contracts, you can go long, you can go short, you can long volatility, short volatility, create structures, create pyramids, create oceans, deserts, whatever you want. Your expression of the market is unlimited, right? There is an unlimited number of ways in which you can trade. You can trade long in one side and short in one side, right? You think banking is strong, IT is weak, whatever. You take a reverse trade, all kinds of ways in which you can trade. Now, I want to ask you a simple question. Let's say you have a stock with a IV above 100 and an IVP at 100. And, you say, hey, this is a good time for an iron fly, short the IV. Market is overreacting, IV will come down. There is somebody on the other side of that trade. Every trade you've taken so far in your life, there is somebody else on the other side. How many of you think that that guy is an idiot? You have done your amazing analysis, you've come up with your trade, you said IVP is high, I'm going to short it. There's somebody taking the other side of the trade. This is a zero-sum game and a negative-sum game because of the charges and whatnot. Who believes that the guy taking the other side of your trade must be an idiot? Exactly. He's thinking you're an idiot, right? So it is not strategies that make money. The biggest person, as long as you're trying to focus on which strategy should I follow to make money, you're going the wrong direction. Find out personally for you, where are you comfortable? What are you comfortable trading? Some people like to take high risk, right? Some people like, you know what, I want to turn around 10% in a day. I'm willing to take a 5% risk. Some people say, boss, I want 0.5% a day, I'll take 0.25% risk. That is you, that is your comfort zone. The moment you're not in your comfort zone with whatever trading approach you take, everyone's trading their own thing. Shiva's buying options, and before I see, he's already out of it, whereas I'm sitting in the same position, I'm sitting next to him, sitting the whole position, the entire day, making slight changes here and there. He's comfortable doing that, I'm comfortable doing this. If I try to do what he does, I will not make it. So understanding that this is my comfort zone, practicing over a period of time, managing risk, will help me retain that positive edge. And if you calculate edge over a long enough period of time, one major mess up can convert the edge that you had over a long period of time into negative. One major mess up. I want to go over a couple more things, but before that, we've all seen this, right? Everyone comes to the market with this intention that, you know what, I'm going to make money. Over a period of time, some people very quickly get out, for obvious reasons. And some people over a period of time struggle, they don't do so badly, but they realize that the kind of effort I'm putting in is really not worth it for the kind of returns I'm able to generate. Right? If I'm barely beating fixed instruments, why am I dedicating my entire life? So eventually there are very few people who continue to stay in the market because, and I personally believe that a lot of this has to do with discipline and behavior. Right? And I want to categorize, for the sake of simplicity, please ignore my language, broader traders into three categories, right? You have the first category, which is the idiot. This is generally the person who completely lacks discipline, has no analysis, has no understanding also of what are the different options. Initially, we saw a bunch of strategies, right? If you don't know what are all those strategies and how you can employ them, you know, if you don't even know the basics of the rules of the game and you're still playing it, a game which is not yours, then you are an idiot. That's how I would categorize you. And of course, discipline completely lacking. Then you have the average trader. This is where I consider myself to also be. You have some amount of understanding. You have taken the time to study the rules, right? You understand where something makes sense, where something doesn't. And the real differentiator for the average trader is truly only money management. It is nothing else. The one average trader who is making money and able to do it properly is the guy who is able to keep his money management and risk management in control. Then you have the genius categories. These are people who know exactly how to calculate their edge in a system, how to maximize. So you would have heard of the Kelly criterion, right? Which tells you that when you have a higher edge, when you perceive a higher edge than what the market is giving you, you place your bet size accordingly, try to maximize your returns. There are these genius people out there, and it always helps, even if you are a genius, to assume that everybody else in the market knows more than you. If you ever get into this fallacy that I know something that other people in the market don't, that is a treacherous path to go down. Always assume that you are probably one of the weakest participants out there, because there are people who spend on immense technology, who spend on an immense amount of research to try and get a minute edge over you. So don't ever make that mistake, right? So always think of, even if you're a genius, consider yourself average. And these are the broad characteristics. And here I also want to address this option buying, option selling, futures trading. A lot of people talk about it as to what makes sense, what doesn't make sense. Quite simply put, for the idiot, it doesn't matter what you do. No matter which segment you're in. If you're in cash, you're going to buy a bunch of stocks. The stocks that go up, you'll book profit. The stocks that go down, you'll average. And eventually you'll realize that the stocks that went up continue to go higher. The stocks that you average have stayed exactly there. Right? You're going to lose money, but you can't lose that much because you're trading cash. Right? Well, what can you lose? When you come into futures, as the idiot, you realize, boss, leverage before even you comprehend, you've already gone, right? So that is not something that is new. Beauty of option selling is when you get in, you might have a couple of big wins if you have no idea what you're doing, but the time you lose, you're going to wipe it all off. So you're going to get pushed out really quick. The problem all starts when somebody starts making money. So when the idiot initially comes to option selling and starts making money, they start perceiving profitable trading over any short period of time as good trading. And that is where it's dangerous. It is always very important to understand the complete risk. Now, I will give you a little perspective on this. I tweeted 8 days before the October expiry that if you take the 17,000 and 19,500, 2,500 point strangle, you are getting 23 rupees, which on a margin works out to be around 1.5% return, 8 days, out of which 8 calendar days, not trading days, 5 trading days. And I ask people, why do you think the market is pricing a risk of 1.5% on a 2,500 point strangle? I got a couple of answers which were quite surprising. They said, this is because institutions have some models, and the models say that it should be priced this way. Otherwise, Ghanta, nobody's going to play these prices for these options. Now, I want to ask you one more question here and need a vote. Do you think somebody is giving you their hard-earned money because they have a model? And if you think they do have a model, do you think that is not a good model that they're giving you that money? Any show of hands for people who think it's free money to do that? I know a lot of people who do it. A lot of people do it and get away with it for years, but has anybody really completely perceived the risk of that trade? Let me give you the actual risk of that trade. Obviously, you can take such a position with a part of your account, so on and so forth. You have certain risk management. Let's say I'm an idiot. I'm going to use 100% of my margin and say, boss, I'm traveling, I'm going on vacation, 8 days. Now I'll get 1.5%. Let me block my entire margin doing this. And I do that. One more fallacy is that something that hasn't happened before will never happen again. Let me tell you how this goes down. Whatever reason, political assassination, nuclear bomb drop, nifty lower circuit, right? From 18,150 lower circuit would be 16,200. One more lower circuit from there, right? 14,600. I've gone from having a margin of X in my account to now owing my broker 5 times that. This 1.5% that I was going for, which I thought it's free money, risk-free, what is there, some model is pricing, has now put me in debt for the rest of my life, mind you. 5 times my margin is what I owe my broker. So not completely understanding the risk of your trades. When you start making profitable trades and you think that I'm making profitable trades, so I must be a good trader. This is a normal distribution. Everyone knows what normal distribution, right? You have an idea, standard deviation. Everybody knows. Anybody who doesn't know? Okay, everybody knows. If I were to, on a monthly basis, keep a 2 standard deviation distance from any stock that I'm trading, I'm trading the same stock. I'm an idiot, so I don't diversify across stocks also. I have all my money, one stock. Reliance is my favorite. That's where I'm going to put it all, right? I'm going to sell a call, which is 2.5% chance of being at the money at the end of the month. I'm going to sell a put also, which has a 2.5% chance. I do this over a long period of time. What is the probability? Somebody give me an answer. What is the probability that either of my strikes go at the money by expiry? 2.5 plus 2.5, 5%. 5%, 1 in 20, which means out of 20 months that I do this, almost close to 2 years, only once will either of my strikes even be at the money. Forget being in the money or giving me a loss. Right? And my logic will be, because I'm the idiot and I've watched some videos, say, if it goes down, I'll do adjustment. I'll do adjustment. But the entire reason you're getting paid is because you might not get that opportunity. Something big enough happens. It's never happened before that we opened circuit, immediate circuit. What if there are literally no buy orders? It's not happened before. It can't happen. It can. There is a probability. That is why somebody is paying you money for it. Nobody gives you money, even if it is a 1 in 1,000 or 1 in 10,000 bet, there is a value to it because there is a risk. Whether it has happened before or not, trust me, probably in the next 10,000 years, if the markets are there, there will be a point where it happens. So understanding the complete risk. And why is this important to understand the complete risk? When you calculate your edge, if you cannot control your risk, when can you not control your risk? If I've used 100% of my margin to take a position that I've just done and I do not have control because the market is shut, and tomorrow I have back-to-back circuits, and I'm not doing this for fear-mongering, I'm just doing this so that people are more aware of the risks that they take on their trades, right? Then I don't have control. I can't cut out. I cannot cut out because I'm sleeping at night waiting for market to open when something has happened in the world. Maybe market opens, maybe it doesn't, but that's the end of my trading career. And after working for so long, I will never put myself in a position where this can happen to me. So moving on to exactly what it is that I do and how I look at the markets. I'm purely an intraday trader. I don't mind not making big gains as long as I know for a fact that my exposure is zero. In fact, if the market is going to open at any circuit, I would be the happiest person because the kind of increase in volatility will be giving me so many opportunities to trade, right? This is the most boring form of a trade, but essentially what I do is I accept bets from both sides. This is an iron condor, but the hedges will be purely for a margin benefit. What I do is at the open, I try to assess what is a particular spread. I'll get over how I do that. I eat risk on both sides, right? And what I try to do is as the day goes, I manage my position with only one rule. All the analysis is a different part with only one rule. At the beginning of the day, I know how much I can make, right? I have an estimate of what is my potential reward. So I set my risk in place. If I know that on a particular day, I'm going for 20 points on a sizing of 10,000, 20,000, 40,000. Now, there are different ways in which I approach this trade, right? So basically, I'm selling both the call and the put option. If I have a view, I'll take the same structure. I'll sell an at the money put and an out the money call, right? If I want to be neutral, I will keep an equidistant spacing. And vice versa if I want to have a bearish view and whatnot. There is only one thing that is completely pre-decided. Everything else is subject to change as the trade goes on, because the trade starts in the morning around 9:30, ends by around 3 o'clock. Only one thing is decided for sure at the beginning of the day. How much will I lose if I lose? And at which point does it not matter what is happening in the market, if there's a good opportunity, yada yada. You'll come up with different reasons to stay in the trade. At which point is my sacrosanct exit? At which point am I done? That is defined. Now, depending on the day it is, and I'll go into how that reward to risk is come in, there are different kinds of risk that I'm willing to put on, but that is the only rule that I cannot break. I cannot tell you the number of times I would have exited from this trade at my stop loss at maybe a 0.5% or a 1%, or on that day if I'm taking a larger risk, 2% stop loss. Just to see, look back and say, had I stayed in that trade, 20% of my account was gone. Same day. So that is what has helped me survive, to know that I'm going to take, depending on what I've decided as my risk for that day. 90% of the time when I exit at my stop loss, right, and because I put up videos of this, people say, bro, if you just held on a little more time, that's the language they use. So it would have come back to profit. I also know that. I also know when I take my stop loss, when that particular day's low is breaking, I'm like, okay, my mark-to-market base, my stop loss is mark-to-market based, right, is hitting, and I'm taking, I also know I will get a better exit. I know that dips get bought. In this entire market that we've been in, it's a buy on dips market, right? Intraday steep dip, it gets bought. Even I know that. But I cannot afford to take that risk on my account after my risk appetite has been met. If you can keep that, like, and adjustments also, what are adjustments, right? So there are not many adjustments that this trade, I'll get into that once I go over how I make it. Each adjustment is a bad trade. You're taking a bad trade. If you're taking more credit from your call side, which is moving your calls down into a down move, you're taking a bad trade. Calls will be underpriced at that point. Now into an up move, you're moving your puts up. Once again, you're taking a bad trade. I'm not trying to maximize the profitability of this trade as I'm managing it. I am always trying to reduce the risk. If the up move is very strong and I'm like, I have to square off my calls and move them higher, in case there's a reversal, the reversal will not bring me back to my initial mark to market. So these are all risk management in place, not to maximize trades. I'm not here to maximize the profit, right? As the days goes on, my target also will reduce if I have to over manage, but my risk will never be moved. And if it's a great day and things are going in my favor, I'll try to push it. If I had a target of 20 points, I'll see if I can push it to 25, 30. But my risk never changes. Now let me go into how I build this trade. Right? There have been some amazing talks about technical analysts. I had the pleasure of speaking with people here who've been studying technical analysis for 20 years. And depending on their trading style, they might require certain aspects. Mine requires a very simple understanding. Right? So I'm trading intraday and I'm looking at the 5-minute chart. There are not many things that I look at. I don't use a single indicator. I never have. It's just what I'm comfortable with. Some people are comfortable with indicators. I just don't want all that clutter. I care only about 3 things. In the past week, what have been the swing highs and swing lows? Because of the psychology of people, there is always support and resistance around swing highs and swing lows. Is there a clear trend line that can be done? Are we making lower highs, higher highs, lower lows? Can we try and figure out what is the short term, super short term, support, resistance, and trend? Right? This is what I'm going for. And thirdly, round figures. Round figures always act as big psychological numbers. So the 500 multiple, 1000 multiples, that is something. So this, when I pulled out on Friday of the Friday before the October expiry, clearly in the short term, we're making a bunch of lower highs and a little bit of technical analysis that I know I'm like, okay, this is a weak situation on a short term basis. But I also try to consider what is the daily chart, right? I'm sure if you're able to see the trend lines, but clearly we are in a bullish channel on the daily part, and there's a good chance that, as has been the case for a long time now, once we dip, that dip gets bought. That's something else to keep in mind. So basically what I want to do is, whenever I'm creating a triangle, I want to stay away from the recent at least 3-4 days swing high and swing low. I want to sell above that, because the real covering only happens when you have a breakout over that, right? So I want to sell above that, and I want to sell below that. That is mainly what I'm getting from my technical analysis. Also, obviously, you look at the weekly and the daily to understand what is the overall long term in this thing, but that won't affect you much because you're an intraday trader. Something else that I keep a good view of is, I'm trading Nifty. Nifty is made up of some stuff. Reliance has a good 15%, right? IT is contributing a good 25%. Banks are contributing a good amount, right? So I need to know what is happening on those individual charts. So the same thing that I'm doing for Nifty, I have to look at the components, right? Sometimes there'll be a balancing act. Maybe Reliance is strong on one day, banks are weak. Maybe IT is strong and Reliance are strong, banks are weak. Maybe banks are strong, and on some days, like the smaller indices, smaller contributors, most days you can ignore unless something is happening. So pharma, FMCG, metals, autos, these you can kind of ignore. You don't have to try and overdo the analysis part, because the trade itself is keeping a large room for error. You're not taking a directional view, but you want to understand potentially which side there can be a move if there is one, right? So that is as far as these charts. Something else that is really important is, what is the average price at which a particular option strikes. So let us say I'm shorting 18,500 call option and 17,600 put option. I want to know what is the average price, not the VWAP along the entire period, the average price at which it was shorted on that day, shorted or longed. Because any real threat, like what is the biggest threat to me if I'm shorting options? It is short covering of that option. Any real threat of short covering will only come once it is above its average price. Price action, the same support resistance works on options as well. There are different ways in which options derive their price, but fundamentally everything derives its price from demand, supply, and urgency. What is the demand? Is it able to meet the supply? Does the demand have to move to catch the supply, or does the supply have to move to catch the demand? Right? Who is in a rush? Based on that, they will move. So this will work, and always ensuring that whichever strike I'm short is trading well below its average traded price on that day. That is also something I need to keep a note of. Right? As far as open interest is concerned, and many people have covered OI, and Shiva has covered it quite extensively, I like to look at 3 aspects of OI. One is, what has been the position that far? So first, I need a historical understanding of OI. I'm not going to cover exactly why OI works, because Shiva has done a lot of that. But basically, this was on Friday when we had a little bit of weakness. You could see that majority of people's positions were built around 18,200 a day prior to that. So when you see that at the money is 18,150, but there is creation of 18,050 and 18,000 straddles. Why do you think that's the case? Why are in the money, where the call is in the money, straddles being written, even though 18,000 is expected to be a good support? It is because people who have positions at higher levels need to short additional calls, need to short additional straddles where the calls are in the money, so that they can increase their lower break even. They're creating a buffer. When the spot is higher, if you're writing a call which is in the money and also writing a put because you want more credit, this is essentially my interpretation of this on Friday would have been that it is being created as protection on the downside. Something else is, from the overall OI, obviously there is a lot more call writing than there is put writing. So the sentiment can be interpreted as bearish. And there are 2 things to note here. Point of maximum congestion. Point of maximum congestion is the point where if you were to take the total number of contracts of puts and calls, you will find the absolute number is the highest. Invariably, there is a tendency for the market to move towards the point of maximum congestion. So invariably, if we are below, and on that day we dipped even below 18,100, the point of congestion by far at all points was 18,200, which is why I would have continued to keep a bias that after Friday, as Monday, Tuesday played out, there's a very high chance that we pull back to 18,200, which is what happened also on Monday. But after that, of course, as Tuesday, Wednesday played out, we had a complete downslide, right? So this is my interpretation of OI and what I look at. Futures OI also very important. Naturally, you want to see What kind of move is it? Is it people who are booking out their profits? That's why the market is moving down. Interpretation would be downside would be limited because it is a profit booking. It is not speculative short positions being built up. So keeping an eye on how is the futures OI changing, how is that reflecting along with the price, that's something I look at as well. Price analysis. Now, price analysis, we came to why demand supply urgency works. There is no set way as to how an option should be priced, or how anything should be priced. It is, at the end of the day, are you and I able to transact? We spoke about bookies, right? So India odds was 1.47. If another bookie is offering it at 1.7, do you think a single person will bet with this bookie? The market itself will move. It will say, okay, I have to either come higher or you have to come lower, right? Otherwise, you're not going to have any business. Each transaction is what the last traded price is. Somebody truly believes it is worth that much for the risk that it's pricing in. And somebody believes that he's taking that much amount of risk, that's why he's selling at that and nothing below that. And they both agree, they shake hands, and that's how you get the LTP. And this happens multiple times a second. So price is king. And I look at three forms of price. What is the at the money straddle pricing in? On Friday, the at the money straddle 18,150 was pricing in roughly under 300 points of risk on the upside and downside. Where did we expire? 17,850. Actually within that risk bracket. The second price I look at is where is the maximum call side open interest, where is the maximum put side open interest. Now if you were to summate the price of both of them, how much of an up down range is that giving? The maximum call side open interest on Friday was at 18,200, right? It was pricing in about 122, right? And the maximum put side, so both together was pricing in about 200 points. Sorry, 112 on the 18,200 call and 81 on the 18,000 put, right? 200 points, which says 18,200 plus 200, so 18,400 on the upside. 18,000 plus 200, so 17,800. That is giving you an idea of how much risk is being priced into that period of time. This is important to know for me. Why? Because I always want to sell above that. Look, if the market is pricing in extremely high risk, I will try to say, you know what, the risk will be lower than that. If the market I feel is pricing in low risk, then I will keep a wider risk range than that, because the cycle of how risk is priced is always like that. For a long period of time, you'll see that risk is underpriced in options, but actual historical volatility might play out higher, right? You will see for a long period, risk is overpriced, but the historical volatility is much lower than that. Why? After COVID happened, for the entire few months after that, pricing of risk was huge. The actual volatility that played out is nowhere close. But that was the fear that was generated because those guys took a hit. They said, boss, I'm not accepting your trade for anything less than this. I'm selling it for this, you take it or leave it. And there's nobody in the world who's selling it cheaper. You yourself wouldn't. Because if you would, then you would have shorted that option instead of trying to buy it, right? So this is what I'm looking at when it comes to price. And all days are not equal. Different people have covered it. But basically, if you're trading weekly options, Wednesdays and Thursdays are the ones where obviously you can capture maximum meat. Simply because when one side option is gaining, the other side option has to lose. Because there's just one day left for them to expire, or they're expiring on the same day. So Wednesdays and Thursdays are when I take maximum amount of position sizing and also try to go for maximum risk reward. Right? Those are the days which will work out better for me. Fridays are pretty hit or miss, right? Fridays, the Black-Scholes model tells you there's no weekend decay, but I don't believe in all this weekend decay, delta, theta, and all that. I understand them extensively. I just don't use them in my stuff. If somebody's holding long options over the weekend and there's no expectation that something will happen over the weekend, in the weekend they'll start dumping it, right? So that is that. But at the other side of the coin is, if potentially something can happen over the weekend, then the risk to carry over the weekend is huge, because it's the only time you're taking risk for 3 entire days. So you'll see that Fridays can be pretty hit or miss. Mondays and Tuesdays I trade a very small size. Whatever I'm trading on the expiry towards the end, I'm probably trading 1/3 of that. This will vary if the market's volatility that's being priced in is huge, right? So if India VIX is large and the premiums available, my sizing will vary. But I'll get to my sizing and that on and so forth, right? So this is what I look at, this is what I analyze, and this is how I come to my trade. Using my analysis, I have understood that, okay, you know what, I'm going to keep a slightly bullish sentiment. Depending on how bullish I want to be, I will have my put maybe, let's say, 300 points away and my call 400 points away. Or if I want a larger risk reward trade, before I enter this trade, depending on how I space it, I know if I'm going for a 20-point day with a 10-point stop loss, or a 10-point day with a 5-point stop loss, anything. I'm very well aware. There are days where I've entered with just a 2-point stop loss. I'm going only for 2 points, nothing more than that, right? So depending on how I space it, that depends on me. There's no right way to do it. If you want to try and target a 2% return, you don't mind giving 1%, go for it. If I feel like, for whatever reason, on that day, I want to trade for 0.5% and give up 0.25%, that works. There is no hard and fast rule to this, right? Depending on how, and I've already gone over this, depending on my view, I'll say I'm expecting market from 18,000 to pull back. So I'll keep my put a little closer, call a little further. I know exactly on a point value how much I'm going to give up for that view. If the view goes against me by 3 points, 4 points, 5 points, I've already decided I'm cutting that view and neutralizing it. Right? So always know if you're going to take a view in this kind of a trade, know at which point you're going to get. I'm not going to sit there waiting for it to go for my entire stop loss of 10 points that day to hit. I'm going to adjust it. How will I adjust it? I'll bring my call down. That's one approach. The other approach, move my put down. Right? I don't only need to, what I'm noticing is that call premiums are not going down that much. So rolling down will not help me. The overall, and there is other aspects of volatility here. IV is shooting up of the weekly options. Then I will just cut the trade. I don't have to wait if I see that the entire day volatility is trending on the upside. So that is where discretion comes. There are part of things that are systematic here. Stop loss is completely systematic, but there are times when I will take a call that today will not be a good day to trade. Why do I know this? Because I have traded this exact same style for like a very long time. I've done this exact same style for a little over like 2.5, 3 years. My initial trading was a little bit different. I didn't take this approach, but I know, and that discretion also gives me a little bit of an additional edge, right? So more or less, only 2 adjustments to this. Take additional credit from your winning side or give up credit on your losing side. Only one rule to this trade. Know at the beginning of the day, what do you stand to gain and how much is it fair to give up against that? No, you will take stop losses. It is absolutely a point. You will take stop losses 90% of the time after your stop loss. You'll say, if I just held out, got it back, it will happen 90% of the time. Whenever you take a stop loss, 90% of the time you look back at the trade, you would have made more money. Learn to feel good about it. You did a great thing by taking that stop loss. I would have gone bankrupt, I don't know how many times if I had held on. How many times? And or I would have taken such a large dip in my equity curve. See, my approach, I've never had more than like a 10% drawdown in any period. I've never had a 10% drawdown because my risk is in and out the same day. Right? And I know when I'm losing, I'm going to reduce my position size. It works for me. Couple other people say, no, you keep the same, you keep the same position. For me, it works. And I know that as long as I keep that stable mind, it'll work, right? So, couple of pointers is one, as I just said, if things don't go your way, run away, come back. Market is going to outlive us. Market will be there long after me, long after you, long after everybody. That's one aspect of running away. Second aspect of running away is, we as traders go through emotional cycles. We're constantly going through happiness, sadness, joy, frustration. Everything costs emotional capital. You have your margin with your broker, which is your actual capital. You have your emotional capital, which is your happiness also costs emotional currency to feel. Your sadness probably costs twice as much. And even if you have been consistently profiting for month after month or day after day, you will get exhausted. You will get exhausted, you will get impatient. So take breaks. Something that has worked wonderfully for me is taking breaks. It doesn't matter if I'm profitable, not profitable, so on and so forth or whatever. And since March of last year, I've not had a single month where I've lost money. Not a single month, right? But I get tired. And when I get tired, I have to take a break. It can be for 1 day, 2 days, 1 week, 2 weeks, 1 month. Do what you must, shut yourself out, take breaks. You will not lose any returns in that period, trust me. If you're trading as a frustrated person, you're going to do far more harm than you can do good. Second thing is something that I just went over is, you think of yourself as like a machine learning algorithm. Depending on what you feed yourself, that is what you end up thinking, right? If you make money on a trade where you behaved stupidly, and be honest with yourself if you behaved stupidly, feel bad about it. Feel disgusted about it. Look at yourself and say, yes, I made money on this trade, but this trade could have bankrupted me. This one trade that I just said, you know what, I'll just wait a little bit more, and it pulled back, and you were like, look, my analysis came right, it came back. It only takes 1 day. Everything that you've done can get wiped out. Always be, so feel disgusted. Force yourself to feel disgusted. Look at that and tell yourself this was the wrong thing to do. So that next time when you're planning to do it, you remember that, okay, I felt really bad last time. Force it, condition yourself, brainwash yourself to do that. When you take a stop loss, right, and many misconceptions around stop loss, feel good about it. Feel really good about the fact that you've taken stop loss. Many people ask me, like even when I was on stage, they were like, you're trading a large quantity, like don't you feel afraid? I am not afraid of taking a loss. I know how much loss I'm planning to take. I'm afraid of sitting in a trade while making a loss and hoping that it's going to come back. So be afraid of the right things, right? And condition yourself. Make it feel good. You said, yes, I took a stop loss today. I took a stop loss at the right time, and that was the right thing to do. That was the good trade to make. And in my sustainable long-term trading career, that is what is going to protect me. Right? And secondly, this trading thing is very personal, right? It's between you and your screen. And Shubhashish added really nicely that tell somebody else so they hold you accountable. That also really works. Be honest with yourself. The moment you start to get into this delusional picture where I'm the hero of my story, only good things happen to me, and you know, it's not my fault, it's the market's fault, there's a operator, there's manipulation, these institutions are rigging the system. Boss, this is the market. You've come here to play, try to make your rules, play your little game, see if you can benefit from it, and do your thing and get out. Don't try to blame anybody else. Be honest about yourself. Take complete accountability. I'll give you an example. There's a video of me on YouTube from just 2 weeks back, right? I'm going to throw myself under the bus here. My broker broke down. It's the expiry. I'm trading 45,000 shares of Nifty. I'm trying to exit a call option. The whole thing is there in HD video. You can check it out. I'm trying to cover it at 3. I covered it at 15. Why? Because I placed the order. I'm sitting there wondering if or not it's going to execute. Whose fault is it? My broker's. It's not my broker's fault. It's my fault. I used to previously have a secondary account which I could use to cover my short position. I have to have that redundancy. I have 3 internet connections, don't I? In case one goes down, I have something else coming in. So if my broker goes down, broker is going to pay me my money or what? You know, probably not even going to refund the brokerage. He'll say technical difficulty happened. I should have had a contingency. So don't blame people. Don't say this whole thing got rigged against me and like, you know, it's impossible for retailers to make money. There are people who do it. If you know that this is the game and you still want to play, then come forward. Otherwise, don't. There are easier ways to make money than the market. Like, people will tell you that. Any trader, ask any trader who's survived in the market long enough, they'll tell you there are easier ways to make money than trying to make money out of trading. Right? Simple ways. Some things to avoid, some more pointers. Avoid the news. And I'll put it as simple as this. 10 people's right analysis, right? 10 people's right analysis is 10 times worse than one person's wrong analysis. Don't listen to other people. You decided this is the parameters I'm going to follow. Okay, I'm going to look at this on the charts. I'm going to look at this on the OI. I'm going to look at this on the price, right? This is more or less how I'm going to structure my view. This is how I'm going to execute my trade. This is going to be my reward. This is going to be my risk. Stay there. If you need fundamentals for your trade, go to Money Control, go to Economic Times, go pull out the actual data, study that. News, social media, lot of noise, and especially as a new trader, you will have no idea how to filter it. You'll have no idea how to filter it, and only harm will be caused to you. Do not tune into that morning news. Put it on mute. In case some breaking news comes, you want to see. Somebody's passed away and all, you want to see. Don't listen to what they have to say. One guy will say, yes, the market is going to bounce from here, this particular level. It's going to come back from there. It's messing with your analysis. You had a plan. You had an entire structure going. You're listening to somebody else, and that's screwing with you. And this has happened to me. This has happened to me wherein I had a plan, and this has happened, continues to happen. It's not like I got all of this down, right? By mistake, I'll listen to somebody else. And I'll be like, boss, like, should I be sure about this? In fact, when I traded live on stage, that was one thing I told myself. Don't listen to a single word of what somebody else is saying. I'm going to trade my style. Till the end, I was short a put option. Doesn't matter. I was short a put option. That's my way of approaching it. I know how to manage my risk as it moves against me, but I'm not going to listen to other people. So don't do that. Second thing is a little bit ironic since I put up YouTube videos, like don't do social media. I wasn't on social media at all, in fact, just till about last year, right? So last year midway, once I started getting on this whole platform. You'll start comparing yourself. I think different people went over this, but don't look at somebody else and said, boss, he generated 10% return. I generated only 1% return. You'll try to do what he does. It is not your system that you have created. You're going to lose. Nothing productive is going to come from it. It is all, majority of it is financial entertainment. You are learning nothing. There is nothing that you have taken. There is a lot of positive content out there. Don't get me wrong. There is amazing content out there. But what you will take will be the worst. You will focus on the worst. There'll be guys who are giving you amazing stuff, knowledge that everything is free. I've never paid for a single thing that I've learned about the markets. But you will initially, when you get in, you will only take the worst. So ignore social media unless you're very good at how you use social media, right? So, and final thing, I've put it as debt, but I want to put it as burden of any kind. People ask me, what is your target? Like, do you have target? Do you have like a daily target, weekly target, monthly target, yearly target? I've never had a target in my life from the beginning. I never said I'm going to like return this much on my money, whether I do it or not, that's secondary. I've never said I'm going to, because it's a pressure on me. What do I do? Let's say I have a monthly target of 5% and I'm down 7%. What do I do to make my 5%? Take more risk? What should I be doing if I'm losing money? Cutting my risk? Completely contradictory. The point where you are losing, you should be pushing down your size, taking it a little bit easy, trying to figure out where you can catch that high probability trade that gives you a good reward to risk, and capitalizing on that. Not trying to say, boss, my 5% is not going to be met, I'm 2% down, now I need to make 7%. You're already losing money and you want to make more. So don't do that, right? You have commitments, you have to pay interest on the money that you're using as your trading capital. You have to then make the risk-free rate. In fact, you have to beat the risk-free rate. Why would you take that pressure? I mean, I don't know, maybe this is me, but any kind of additional pressure to make money on me, I feel like will 100% make me lose money. I feel like I will not be able to keep the same stability, peace of mind to say that, you know what, boss, I'm frustrated right now, I don't want to trade for 2 weeks, I want to go on a vacation. Arey boss, interest to bharna padega. I have to pay, right? So that's something else. And more or less what I want to put across here is that don't focus too much on the analysis and setups and trying to perfect them. Focus more also on all your behavioral aspects. You can take any trade. You can take any trade. You can create a simple setup and say, I'm going to run this particular. As long as your money management is on point, right, you will do well, right? So thank you so much that I will take questions now. So.
Thank you so much, Shreyas. Very comprehensive and very informed. You touched upon every topic, like psychology also and position sizing, everything. So if you can shed more light upon the premium pricing, risk premium pricing.
Right.
Like I was not sure about it. How does it price in?
Absolutely. So I'll answer your question with another question. What do you think moves the market? Do you think cash market is what moves the market? Futures moves the market, or options moves the market? What moves the market?
Cash.
You think cash moves the market? Okay, excellent. So here's the thing. The index is calculated on the cash weightage. But actually you can move the market with any instrument. You have a future, right? If there is a huge discrepancy between the future and the cash, let's say I place a huge order and completely kill the liquidity on the future, right? Then the cash market has to catch up with it. Otherwise there's an arbitrage opportunity. Can you make a future out of options? Can you use options to create a synthetic future? You can, right? You buy a call, sell a put, buy a put, sell a call. So similarly, if there's a discrepancy between because of demand and supply, because price moves because of demand, supply and urgency, right? If I place a huge buy order on the call options, the future and call option, there'll be arbitrage, synthetic future and future. So everything moves everything. Right. Now, basically anything has value because somebody, right now, whoever is transacting on it is pricing in that much. From the seller's perspective, he will price in the risk that he anticipates. Right. So the reason pricing of options is important, it gives you the current anticipation of risk. It is up to you to decide whether you think, for example, let us say in the earlier option chain, let me just give an example through that. See, if you buy the 17,900 put option, right, on Friday for 55 rupees, and you sell the 17,850 put option for 45, how much are you paying for that spread? Oh, okay. Okay, you're paying 10 rupees. We don't need that on the screen, right? You're paying 10 rupees for that spread. Your maximum profit is 50 rupees, right? That's because the seller is pricing in a probability of 1 out of 5 times. Even if you look at the delta value of that strike, it will be 0.2, right? So he believes that that is the pricing of risk. There is 1 in 5 chance that that strike, 17,850, is at the money by expiry. So that is how you know, based on what somebody is able to put money on. You check what are the odds. You're giving a 10:5 bet on that. Think of it from a bookmaker's perspective. 10:5. Then you're like, I'll take that bet because you believe that market is going to go down. So you think 1 in 5 is a great bet. That horse is going to win is what you feel. Maybe the seller feels, no, the actual pricing should be 1 in 10. So he will short, he will take the other side. And he will say, I will pass it off when it is 1:10. So it's all about right now, market is pricing in. This is the probabilities that market is pricing in. Are you on the buying side of that probability or selling side of that probability? That's for you to decide.
Thank you. Thank you.
Yeah.
Shreyash, very glad to listen the top secrets of the market from you actually.
Thank you.
Everyone has to follow. And can you please repeat the process of the expiry day? What went into your mind and how you could manage that entire trending day as a seller? If you can explain that, it is a practical example for us actually.
Absolutely. Right, so you guys were here for the expiry day, and my initial view was actually that 18,000 most likely would hold for the expiry. Right, that was what I started off with. My initial position was I was short the 18,350 call option, and I was short the 18,050 put option. Somewhere for about 30 points is what I shorted the spread. My view went immediately wrong because that 30-point spread, and what I'm targeting for the day actually is somewhere about 30 points. I'm willing to give up 15. My view went immediately wrong as the market started to slide. There started to be an imbalance between the two premiums. And on expiry, the maximum imbalance I will allow, especially in the first half, is 2:1. So I cannot have one option trading more than twice the price of the other option. As my put started to gain, my first reaction was to square it off and roll it down, right? As the market continued to head down, once again my put started to gain, and call is losing some amount of value. I need more credit from the call side. What are my two options? Roll down my put or roll down my call? So I take a little bit more credit from the call side. The entire day was just following this process. It was that, okay, my put is starting to trade almost twice as expensive as my call. And of course, using a little bit of discretion, I always ensured my call when I entered, rolled it down, always had little more credit than my put because clearly it's a downtrend market. But my trading style, I have to have both legs. That's what gives me comfort. That's what I know. So even on a trending day, I can manage it by taking this consistent process. And that is more or less how the entire expiry played out. I don't know if you constantly kept track of my screen. Despite that 2% move on Nifty, I was never down more than 2% on a mark-to-market basis intraday ever. Right? Towards the end, I closed positive in 5 because it was not my day to make money. But I never let my mark-to-market slide. I'm always balancing risk. There was a point at which we pulled back also. Puts crashed and calls gain. I once again took off the call, moved it higher. I don't want to go anywhere near the money. See, I don't know, there are some videos of me from earlier last year where I'm always trading at the money. But I was trading 1/10 my sizing in intraday back then because there was also leverage concept, right? Right now, I'm more comfortable trading far away because I'm trading much larger sizing than what I was doing then. And I want to keep a smaller risk to reward. And on a returns basis, it really doesn't make too much of a difference because everything is risk adjusted. So I hope that answers your question.
And in that case, actually most of the people try to do adjustments.
Yes.
When market is falling like something like so, as long as that they exit from the previous call options, and again they will take another call option below something like this.
Correct.
So in this case, if market goes reversal again, so
Correct.
in this case the call option will become in the money, and again they will be in trouble.
No, you keep some distance, right? I mean, at all points, I'm keeping at least 100 points of distance or whatnot. That's what happened also. We had a pullback. See, yes, we went to the low, we had a pullback. Then again, we went and broke the day side. So when we had a pullback, very simple. Now, because there was a huge increase in put premium, as there's a pullback, the put is going to give up value. Yes. The call is going to start gaining, but first the put is going to give up more. Then I'm moving my call back up.
Okay.
So you're constantly following the market wherever it's going. I told you, you're just literally doing only 2 steps. You're moving your call up and down, moving your put up and down. You cannot give up more than what you decided you want to capture for that day. Simple. It is so simple that people will be like, this is too simple for it to make sense. This is exactly there is. The only thing is you need to get out in time. There were some people who gave strategies and said, okay, if this goes to 3x, you should get out. That is where the edge comes from, not from the fact that you're selling options that you have an edge. Option selling doesn't have an edge. Money management has an edge. You might have an edge and be an option seller and attribute your edge to option selling, but no, it's actually to the money management. But of course, with overnight, there is always that risk that you don't get to do that. You know, you have an idea that if the put premium that I've sold, which I'm carrying overnight, if it goes 3 times, I'm going to exit my position. There are times where you won't get an opportunity to do that, which is exactly what I had gone over before, which is why it's important to always be hedged and to understand your max loss and say, if my system says I can take once in a while 20% draw down my capital, I'm fine with it because I'm generating X percent. That makes perfect sense, right? So yeah,
Thank you.
thank you.
Hi Shreyas, it was a great presentation and a lot of insights were really amazing. So I just wanted to ask one thing from you. What have you learned from your worst days of life? Because as I have heard from many traders that this doesn't work for a period of time, this doesn't work, so I take a break, so I re-strategize my strategy or I do opposite. So something like, what have you done, changes in your strategy on worst side, where period of continuous failures, your strategy doesn't work. So have you taken a break or you have re-strategized or you have done something else?
Absolutely. So this is kind of like a great question, but I think I got it right, so I will go over it. So it's kind of like this. When you've traded a similar style for a long period of time, there's nothing wrong in being in a comfort zone. There are phases in the markets. Volatility in the market never remains the same. Every 3 months, the nature of volatility will vary. Okay? You cannot expect one particular approach to always make money or make big money. Okay? Your approach should be when it's making money, make good money. When you're losing money, lose less money. That has to be there. If you try to, like if you're a cricketer, and because at that point of time not too many people are watching cricket, you go decide to play another game, you won't be very good at it. It's not that the guy who's buying options will not make money, like people who are buying into momentum. But I haven't practiced that system well enough to be able to convert that. So in fact, some of my biggest losses, especially in my initial days, was, boss, I'm finding this strategy very difficult to manage. Let me just like buy into it, right? Sometimes it worked out really well, but I realized that this is not sustainable. I can't do this every time. So I don't trade something where I don't have some kind of mastery around it. So you have to stick to your strategy. And when it's not working, right, the phases of it not working, like a lot of system traders will tell you past 3 months, people who have been systematically trading have had a little bit of a tough time. So not directional people. Cut size. Cut size. It's not working for you. Previously, I used to be trading like my full size on every day. Right now, it's not working. I'm trading 1/3 size on most days. On Wednesdays, maybe 2/3 size. On Thursday, only in the last part of Thursday, my full size. And that works. Yes, I'm going to have a period wherein I'm going to have a little bit reduced risk, but I'm not going to have the same kind of drawdown if I was trading my full size. Right? So periods will not suit you. It's about understanding those periods and taking it light during those periods. Take a break. Right? This month, first 2 weeks, I was on break. I was like, I want to relax. Right? Not because the previous month wasn't profitable. I was profitable the previous month. But I was feeling stressed out. Take a break. Right? Yeah. Any more questions?
Okay, I think we've exhausted the questions for you, Shreyas. Thank you very much.
Thank you all
Ladies
so
and
much.
gentlemen.
It has
Thanks, Shreyas.
it has been a huge pleasure, and I look forward to like learning more from all of you here. It's been truly amazing. Thank you so much.
Thanks, Shreyas. Thanks.